Hello everyone and welcome back to our podcast. My name is Diana Karamanova and today we are discussing a week when the USDA report itself was relatively calm, but the market definitely wasn't. The title of this episode is Quite WASDE, Loud Market, Why Macro Matters More Than USDA This Week. And today I'm joined again by Vlada Zhigulska. Hi Vlada, great to have you back.
Hi Diana, happy to be back. Yes, this is exactly the kind of week when the headline is not just the report itself, but everything happening around it.
Exactly, because the market is trying to balance several stories at once. On one hand, WASDE itself was relatively calm. On the other hand, geopolitics, crude oil, fertilizers, freight, weather, and even tender activity are shaping sentiment much more aggressively than the report alone. And that's really the core idea of today's episode. USDA gave the market data, but macro is still giving the market direction.
Yes, and the tone shifted again very quickly. Earlier, the market was hit by heavy volatility because of the Iran situation, the war premium in oil, and fears around the Strait of Hormuz. Then sentiment cooled after Trump suggested the conflict was pretty much finished, which triggered a sharp drop in oil and broader commodity liquidation. In reality, we see huge changes in, for example, the actual edible oil market in China. 2 weeks ago, high-lake crude sunflower oil was traded at 1,670 USDA from Ukraine to China. Today, the price starts at 1,735 USDA, and for example, crude rapeseed oil previously was discussed at 1,170 CFR Chongqing port, and today level is already 1,198 USD from buyer side. For example, yesterday it was 1,176. So the market changes not even every day, but every hour.
Exactly, and that's very important. So this week is a very good example of how the market is reacting not just to one report, but to a constantly changing macro backdrop.
Yes, and when macro becomes that loud, the market can switch mood very fast.
So let's break it down by markets. The global wheat balance still looks broadly neutral to slightly bearish. Ending stocks were reduced a little to 277 million metric tons, but it's still a 5-year high. So the market still sees comfortable global supply. At the same time, export competition remains strong, especially with Argentina pushing more aggressively into the market.
Yes, and that's why wheat still struggles to build a strong bullish story from the balance sheet alone. There is some support from weather concerns and from the decent US export pace, but overall the market still sees comfortable global supply and aggressive competition among exporters. But wheat is also getting support from active tender demand, and that matters for sentiment. Georgia's wheat tender for up to 120,000 tons resulted in no purchase, but a new tender was expected almost immediately. Saudi Arabia bought around 794,000 tons of wheat, slightly above its target. Tunisia bought 100,000 tons of soft wheat and 50,000 tons of durum wheat. Algeria also returned with a fresh soft wheat tender. So even if the balance sheet itself is not strongly bullish, the market still sees buying interest from major importers.
Yeah, and that's also important because it shows that the physical market is still active. On the Ukrainian side, offers for 11.5 wheat were heard around mid-high to 30s FOB POC ports for April-May loading. Tradable ideas were seen lower. Buyers in Egypt were indicated levels around low to 50s, CIF Egypt as a demand side, which actually looks low with freight from Ukraine is around $25.
So in wheat, the conclusion is quite balanced. Fundamentally, ample stocks and strong exporter competition keep the market from becoming clearly bullish. But tender activity, weather headlines, and freight risk still prevent the market from becoming fully comfortable on the downside.
Yeah, thanks a lot. So let's now move to corn. The global corn balance also looks neutral to slightly bearish. USDA increased global production, mainly because of larger crops in Ukraine and Brazil, which more than offset the cut for Argentina. As a result, global ending stocks rose to 292.8 million metric tons. So, on paper, the balance sheet became more comfortable.
Yes, but corn has a different story in the physical market. Export demand from the US has remained relatively strong overall, even though weekly inspections declined from the previous week. And for Ukraine, the local market is under pressure for more practical reasons. Prices remain pressed by stronger competition from Argentine corn and by weaker demand from the Middle East. And there is one more point in corn that the market is watching closely. Acreage economics in the US. With the high fertilizer and input costs, some US farmers may prefer soybeans over corn this season.
Let's also focus in on the Ukrainian market, and I wanted to share some levels. Current offers were heard around $225 to $28 per metric ton, with bids around low 220s. On CIF market, selling ideas were around 250 CIF Marmara and 255 to 56 USD per metric ton CIF East Coast Italy for April-May. On the domestic market, bids were indicated around $10 to $13 per metric ton CPT POC for spot delivery.
So in corn, we have a market that looks somewhat softer fundamentally and also faces pressure in Ukraine from export competition and weaker regional demand. That is why going forward the markets will be watching Brazil's safrinha planting, US planting progress later on, and the Argentine harvest very closely.
And now soybeans, probably the most interesting market this week. Soybeans, a very good example of this quite WASDE loud market theme. USDA did tighten the soybean balance sheet slightly by lowering Argentina's crop and trimming global stocks, but beyond the report, soybeans are also trading oil, weather, Brazil, and speculative positioning.
Yes, and Brazil remains central here. So we have a classic mixed picture. Logistical and harvest delays support prices short term, but the sheer size of Brazilian supply keeps the broader fundamental picture heavy.
And Argentina adds another layer. Crop conditions there are rising, with good to excellent to 30% from 26 the week before, while poor to very poor level fell. So despite the USDA cut, crop conditions have improved recently, which is still a mild pressure factor for prices.
And then there is a fund positioning. The net long fund positions in the US soybeans rose. This is a very important point because it means soybeans are being supported not only by soybean-specific fundamentals, but by outside market energy dynamics too.
And in Ukraine, the soybean market is also supported. For example, buyers for GMO soybeans are at 455 USD CPT POC ports, the same levels you can find on DEP Izov at Ukrainian Polish border. Buyers for non-GMO soybeans are at $470 CPT POC ports, and at destination markets, buyers are at $515, $520 CIF Marmara, while offers are at 490 USD FOB POC ports.
So soybeans still look the most sensitive to macro. If oil is strong, soy oil reacts and soybeans can extend gains. But if crude suddenly breaks again, soybeans can also correct quickly because this market is already quite crowded from a fund positioning point of view.
And one more important point we definitely need to add this week is fertilizers, because this Middle East story isn't only about oil, it's also about agricultural inputs. So any disruptions through the Strait of Hormuz immediately raises concerns about fertilizer availability ahead of spring planting.
Yes, and that can become a major secondary driver for agriculture. If fertilizer prices rise, farmers may reconsider acreage decisions, especially between corn and soybeans. Corn is more input sensitive, so higher fertilizer costs can make soybeans relatively more attractive. And when you combine that with higher fuel costs, production expenses across the farm sector rise further.
So even if the grain market isn't immediately pricing that in every day, this is one of those macro risks that can quietly become much more important. And of course, the weather remains in the background too.
So once again, the market is balancing multiple layers at once. A relatively calm USDA report, geopolitical swings, energy volatility, fertilizer risks, tender demand, and weather. That is exactly why the market feels louder than the report itself.
So the main takeaway this week is simple. WASDE wasn't the whole story.
Yes, and that is why in weeks like this, you cannot read the market only through the balance sheet, and also have to read the macro environment around it.
Exactly. Thank you, Vlada, for joining me today.
Thank you, Diana.
And thanks to everyone listening. This was Prospex Agro Market Talks behind the Brokerage Desk. This conversation is shared for informational purposes only and shouldn't be treated as trading advice. See you in the next episode. Bye.
Bye-bye.